This chart shows how the top 0.1% wealthiest investors in the world really allocate their money. 28% in real estate, 28% in private equity, and public stocks, the thing that your advisor probably has you in almost entirely, is only 23% of their portfolio. This data comes from Tiger 21. Now, if you haven't heard of them, Tiger 21 is a private peer network for the ultra high net worth investors. The average member has over $100 million in investable assets. And every quarter, members share their actual portfolio allocations. This data is public, but you won't hear about it from your financial advisor. I'm Christopher Nelson, and in this video, I'm going to show you exactly why, and more importantly, what you actually need to build before any of this becomes possible. Because the question that everyone asks when they see this chart is, how do I get access to that? And that, my friend, is the wrong question. Let me tell you what I mean by that. When most people see this allocation, 56% in real estate in private equity, they want to reverse engineer the portfolio. They pull up ChatGPT and ask about the best private equity funds. They want to ratchet up their rental property count. They try to copy the allocation. And ultimately it doesn't work. Not because the investments are bad, but because they're trying to replicate the output without building the foundation that makes this output possible. Here's the insight that changes everything. This portfolio is not a starting point, it's a result. The investors in Tiger 21 didn't stumble into this allocation. They built the base first, and what they built is what we're going to talk about today. Let me walk you through this allocation differently than you've probably seen it before, focusing on the foundation of each. Let's start with real estate at 28%. This is the single largest allocation, and here's what most people miss. Institutional real estate isn't just buying a rental property in your personal name. When real estate is held inside a properly structured holding company, an LLC aligned to your trust, you create a legal wall between that property and everything else that you own. The investment can have a bad outcome without it threatening your entire financial life. That's not complicated, but it has to be built intentionally before something goes wrong. But the entity alone isn't enough. If your personal finances and holding company finances are running through the same accounts, same credit card, same bank account, same books, a court can look at that and decide the separation was never real. They call it piercing the corporate veil. And when that happens, the protection disappears, the walls come down. This is why separate bookkeeping isn't just an accounting preference. It's what makes the protection legally defensible. The entity and the books have to match. Now look at private equity at 28%. To even access most private equity investments, you need to be an accredited investor. And here's the data point that should get your attention. If you're watching this video and you have over $1 million in assets outside of your primary residence, you're likely already qualified. The barrier isn't legal, it's educational. Most people don't know how to find high quality operators because their advisor can't make money introducing them. But here's what nobody tells you about getting access to private equity for the first time. The deals feel urgent. A good operator opens a fund once every few years. The window is short. And when you're sitting across from somebody with a compelling track record and a polished deck, the pressure to move fast is real. And that's exactly when most people make expensive mistakes. The Tiger 21 members allocating 28% to private equity aren't just getting access to better deals. They're making decisions inside of a framework built long before any deal arrives. This framework has 3 pieces. Number 1, an investment thesis that defines your criteria for evaluating operators so that you already know what a yes looks like before the pitch starts. Number 2 is portfolio architecture. This defines your target allocation before any investment arrives. What percentage goes to each asset category and how much can be locked up into liquid investments at any given time. That's what prevents you from waking up one day and realizing that you're 80% allocated in a single asset category. Third, an investment policy. This governs your due diligence process. It's the written rules that protect you from making emotional decisions on an investment that sounds great at dinner and looks different 6 months later. Now, let's look at public equities at 23%. This is important. Stocks aren't gone, they're still there, But notice they're a minority position, not the whole game. For Tiger 21 members, public markets are one component of a diversified system, not the entire portfolio. So the question is, why is that so different from what most advisors recommend? Follow the money. If your advisor is paid on asset under management, AUM, they get paid on what they manage. Private equity investments, real estate held in your own entity, alternative investments, they can't charge fees on those, so they won't recommend them. Not because they're wrong for you, but because they don't fit the advisor's business model. And that's okay if you go into the relationship knowing the limits. Here's the irony though. Your advisor has actually done one thing right. They've built a framework around public equities. There's an allocation target, a rebalancing policy, a benchmark to measure against. The problem isn't that they built a framework for stocks. The problem is they stopped there. The architect phase is about building that same disciplined framework for your entire portfolio, not just the piece your advisor gets paid to manage. We're talking about a portfolio built around income, protection, and optionality, not just growth. That's a fundamentally different way to think about wealth. I call it an evergreen portfolio. So what does that foundation actually look like? Every sophisticated wealth structure, whether it's a $100 million family office or a $3 million portfolio being built intentionally, has the same three components underneath it. And these are exactly what the architect phase of building a microfamily office is designed to produce. Vision is the starting point. What is this portfolio actually supposed to do? Replace your income, build something for the next generation, create enough margin that work becomes optional? Most people have never answered that question with specificity. And without a clear answer, every allocation decision becomes a reaction to whoever has the best pitch deck that week. Next up is structure. This is the legal and operational layer. The entities, the accounts, the bookkeeping. We touched on this with real estate, but it applies to every asset category. Where does income flow? How is liability managed? How is this whole thing held together? Because without structure, you're holding assets in ways that create unnecessary risk across the board. And finally, strategy. Strategy is the investment thesis in portfolio architecture, the written documents that govern every allocation decision. What asset categories do you invest in and why? What are your liquidity limits? What's your criteria for a yes? We touched on this with private equity, but those documents aren't just for PE. They govern the entire portfolio. When these three things exist, something fundamental changes. You stop reacting and you start executing. Advisors, CPAs, and deal sponsors serve you differently because you show up as a CEO with a defined strategy, not a client looking for direction. That's the shift. So, if this is landing for you, here's the practical first step. Before you make another investment, answer three questions in writing. Number one, what do I actually want my portfolio to accomplish? Be specific. Replace income. What number? By when? Number two, is there a legal wall between your investments and your personal finances? Or is it all just commingled, creating a ton of unnecessary liability? And three, do I have a written investment thesis? Not a vague idea of what you invest in, a written document that defines your allocation logic and your decision criteria. Most people can't answer all three clearly. And the gap can be the difference between wealth that ends with you and wealth that lasts for generations. The portfolio is the output. The foundation is where you start. If you're between $1 million and $30 million in net worth, and this is clicking for you, I would love to have you at our next live workshop. It's a 2-hour deep dive where we talk through exactly how to build this foundation, your vision, your structure, and your investment thesis inside of the architect phase of the microfamily office. You're going to leave with a legacy statement, an investment thesis, and a portfolio structure tailored to your specific goals. At the time of this recording, we've had over 1,400 people just like you attend this workshop. So head to wealthops.io/go or click the link below to register. Our next workshop is likely just a few days away. And after you register, check out this video It goes deeper on the evergreen portfolio structure that we cover inside of the workshop. Let's keep building.